In nearly every generation, financial markets face an event that rewrites the rules of survival. The Great Depression of 1929, the stagflation of the 1970s, the global financial crisis of 2008, the COVID-19 collapse in 2020, and the 2022 bear market that wiped out 70% of growth stocks. Each crisis was different in cause and character. Yet the same forces were always at work: leverage, liquidity, and psychology. These repeating variables produce what Ray Dalio calls the long-term debt cycle. Once you recognize that pattern, you stop trying to predict and start preparing. When markets melt down, most investors react emotionally. They sell at the bottom, hoard cash when it earns nothing, and chase returns when valuations are stretched. But a small minority behaves differently. They structure portfolios not for the next quarter, but for the next quarter century. History shows that while countless strategies have been invented, only 3 positions have consistently preserved and compounded wealth through every major crisis since 1929. Before identifying them, it's worth revisiting what those 5 crises actually represented. 1929, the Great Depression. A decade of debt-fueled optimism ended in an 89% collapse in U.S. equities. Prices fell faster than wages. Deflation turned cash into a scarce, appreciating asset. Those who were liquid bought assets at pennies on the dollar. Those who were leveraged lost everything. The core lesson: liquidity equals survival. 1970s, stagflation. After the gold window closed in 1971, inflation soared into double digits. Bonds, the traditional safe asset, delivered negative real returns for an entire decade. Cash lost purchasing power month after month, yet tangible assets, particularly gold, rose 24-fold. The lesson: when governments debase currency, hard assets protect real wealth. 2008, the global financial crisis. Decades of credit expansion collapsed under the weight of housing leverage. Global equity markets lost $10 trillion in months. Yet liquidity once again dictated survival. Investors like Warren Buffett, sitting on billions in cash and short-term treasuries, provided capital at panic valuations and reaped extraordinary returns. The lesson repeated: dry powder is optionality. 2020, the COVID crash. Within 3 weeks, the S&P 500 fell 35%, the fastest decline in modern history. Central banks printed $4 trillion to stabilize credit markets. Gold spiked 42% within 5 months. Equities rebounded to new highs by 2021. The lesson: crises no longer purge excess. They trigger unprecedented monetary expansion, rewarding those positioned across liquidity, hard assets, and equities. 2022, the modern bear market. After years of zero-rate policy, inflation returned. Growth stocks fell 70%. Long-duration bonds lost 20%. And diversification through traditional 60/40ths portfolios failed. Meanwhile, Treasury bills yielded 5%, gold reached record highs, and the S&P 500 recovered within a year. Once again, the same trio stood firm. Across these 5 episodes, every sophisticated investor eventually arrived at the same conclusion. Survival doesn't come from prediction, but from positioning. Dow. There are 3 positions that did not merely endure the chaos, but used it to grow. Position 1, cash and treasury bills. Protection against deflation and crisis, offering liquidity when markets freeze. Position to physical gold. Defense against inflation and currency debasement when paper money loses credibility. Position 3, the S&P 500 index. Ownership of the most productive real assets companies that outgrow every downturn over time. Evidence spans a century of data. Each crisis punished concentration and rewarded balance between liquidity, real value, and productive capital. It's not theory, it's pattern recognition. In 2025, that pattern is repeating. Buffett now holds over $325 billion in cash, and T-bills 30% of Berkshire's assets, the largest cash position in its history. Central banks are buying gold at the fastest pace since the 1950s, over 1,000 tons per year. And long-term investors continue to hold diversified equity exposure, betting not on any single company, but on the productivity of an entire economy. These signals suggest the smart money is preparing, not predicting. When liquidity tightens and risk premiums rise, cash buys time, gold holds value, and broad equity ownership compounds through recovery. The pattern remains elegant in its simplicity and brutal in its consistency. For the viewer, this first lesson is philosophical as much as financial. The goal isn't to find the next big thing, it's to avoid permanent loss and participate in the next expansion. The markets have changed, human behavior hasn't. Crashes will continue, inflation will recur, debt cycles will reset. But across a century of evidence, three positions have outlasted every paradigm shift. He sat in cash through the chaos, then began deploying capital in 1932 and 1933, buying productive assets at pennies on the dollar. By 1936, he was wealthier than before the crash. The principle is timeless. In deflation, liquidity is leverage. The 2008 global financial crisis. 80 years later, the same pattern repeated. It's the buffer that keeps portfolios intact and the powder that fuels re-entry at generational lows. In risk parity frameworks like those popularized by Ray Dalio's Bridgewater, cash and short-term treasuries serve as volatility dampeners. They reduce drawdowns and preserve capital during deleveraging phases. In deflationary regimes, they are among the few assets with positive real yields. And during inflationary shocks, rising short-term rates quickly adjust returns upward, providing protection without duration risk. Cash is therefore not dead money. It is sleeping opportunity. How to use cash strategically? Maintain liquidity buffers. It represents the institutional memory of capital markets, a recognition that cycles end, but opportunity returns to those who wait. The rational investor today does not ask, when will the next crash happen? Instead, they ask, when it happens, what will I be able to buy? Cash answers that question. Summary: over a century of crises, cash and treasury bills have delivered the same value proposition. but it is the foundation of resilience. In the end, cash is not about avoiding risk, it's about timing exposure. It keeps you alive long enough to capitalize when the world forgets that cycles never end. That makes position one the first pillar of survival in any financial storm. During the early years of the Depression, gold was officially fixed at $20.67 per ounce under the gold standard. As deflation destroyed asset values, gold remained constant in nominal terms, but rose dramatically in real purchasing power. Then, in 1934, President Franklin D. Roosevelt revalued gold to $35 per ounce, a 69% overnight gain. For those who held gold or gold-backed claims, the devaluation of the U.S. dollar instantly increased their wealth, while others lost fortunes. This episode proved a timeless truth. When governments face deflationary collapse, they eventually respond with monetary expansion, and gold captures that adjustment directly. The 1970s, the decade of inflation. When the U.S. closed the gold window in 1971, it freed the dollar from convertibility and unleashed a decade of monetary inflation. Between 1970 and 1980, gold's price soared from $35 to $850 per ounce, a 24-fold increase. Meanwhile, real bond returns were negative for years and equity markets stagnated. Gold was the only major asset that not only preserved value, but multiplied it as inflation eroded the worth of every paper asset. Gold recalibrates as the natural counterweight. The 2022 to 2025 pattern. Central banks know over the past 3 years. Central banks have bought more than 1,000 tons of gold annually, the fastest pace in 70 years. China has increased its official reserves from 1,000 to over 2,000 tons. With unreported holdings likely higher, Russia liquidated most of its U.S. Treasuries and replaced them with gold. Poland doubled its reserves. Turkey, India, and Singapore all expanded their positions. This is not random diversification, strategic de-dollarization, preparation for a multipolar currency system where trust in the U.S. fiscal trajectory is fading. With U.S. debt surpassing $36 trillion and deficits entrenched, foreign creditors are converting paper claims into metal insurance. During strong growth with high real yields, it underperforms. That's why it serves as insurance, not the engine of returns, but the stabilizer when confidence cracks. Gold versus paper promises. Every crisis reveals one paradox. People chase the illusion of safety in government bonds and fiat cash. Yet those instruments depend on the very system under stress. Gold depends on no one. It is not a claim on an institution. It is the institution of last resort. Ray Dalio summarized it simply: if you don't own gold, you know neither history nor economics. The point is not ideology, it's probability. Over a century, fiat currencies have lost 98% of purchasing power. Gold, measured against them, has maintained or increased its real value. Summary: gold's story is the story of money itself. In the long arc of economic history, every financial system resets, every currency weakens, and every bubble bursts. Yet one force consistently rebuilds value: human productivity. The S&P 500, a diversified index of America. S500 largest publicly traded companies, represents that force in its purest form. It is not a bet on speculation. It is a claim on the ingenuity, labor, and innovation of an entire economy. For investors who understand cycles, the S&P 500 is not just an equity benchmark, it is the engine of real wealth creation. Across the last century, it has endured wars, depressions, inflation, and policy shocks. Still, its compounded return, including dividends, has averaged roughly 10% annually. No other liquid, diversified asset has matched that record of resilience. Why the S&P 500 survives every crisis? The reason is simple but profound. Capitalism adapts faster than it collapses. When individual companies fail, new ones emerge stronger. The index continuously rebalances toward the productive frontier of the economy, shedding the obsolete and embracing the innovative. Owning the S&P 500 is therefore owning the process of creative destruction itself. Crashes destroy excess valuation, not the underlying capacity for growth. As long as human enterprise continues to solve problems, corporate earnings rise over time and the index recovers. Every crisis is a temporary liquidity event against a permanent upward trend in productivity. The Great Depression, 1929 to 1945. During the Depression, stocks fell nearly 89%, wiping out a generation of investors. Yet by 1945, the S&P 500, including dividends, had recovered to pre-crash levels. By 1950, it had doubled from its 1929 peak. By 1960, it had quintupled. Investors who held through the worst economic disaster in modern history, or who reinvested dividends at the bottom, eventually outperformed every other asset class. The lesson, time, not timing, was the differentiator. The 1970s stagflation. The 1970s were a brutal decade for equities in nominal terms. The index moved sideways for over a decade as inflation eroded purchasing power. Yet when dividends are reinvested, total returns averaged around 5 to 6% annually. Then came the 1980 to 2000 bull market, nearly 2 decades of compounding at 17% per year. Those who endured the stagnation of the 1970s captured the most powerful equity expansion in history. The pattern is consistent. Patient capital is rewarded for staying invested when pessimism peaks. The 2008 financial crisis from October 2007 to March 2009, the S&P 500 fell 57%. Yet by March 2013, it had fully recovered, and by 2020 it had risen 400% from the lows. A $100,000 investment made in early 2009 became roughly $500,000 in just over a decade. The point is not that investors should ignore risk. It's that markets have always recalibrated and recovered faster than most expect. When central banks flood the system with liquidity and fiscal policy reignites demand, corporate profits return long before sentiment does. The COVID crash 2020 and the 2022 bear market in March 2020. The S&P 500 collapsed 35% in just 23 days. By August, it was back at new highs, the shortest bear market recovery in modern history. Those who held broad exposure captured a 100% rebound within 2 years as the index reached 4,800 by December 2021. Then in 2022, another bear market struck. Growth stocks down 70%, the index down 18%, yet by 2023, it had rebounded 25%. Once again, patience triumphed over panic. Empirically, over every rolling 15-year period in U.S. market history, the S&P 500 has never produced a negative total return. The reason is compounding corporate profits, dividends, and innovation accumulate faster than crises can erase them. Why equities are the long-term inflation hedge. Cash preserves liquidity. Gold preserves value, but equities preserve purchasing power through productivity. When inflation rises, companies raise prices. Their nominal earnings adjust upward, while their tangible assets, factories, technology, intellectual property, retain utility. Owning broad equities is not speculation on growth. It is participation in the inflationary process itself. As long as you own productive assets rather than consume them, inflation transfers wealth from spenders to owners. That's why the S&P 500 remains the primary vehicle for long-term compounding. Behavioral edge. Enduring volatility. The biggest risk to equity investors is not market decline, it's human reaction to it. During every downturn, media amplifies fear, retail investors capitulate, and professionals overhedge. Yet the historical data is unambiguous. Missing just the 10 best days of the market over a 20-year span can cut total returns in half. Professional investors recognize this and separate volatility from risk. Volatility is temporary price fluctuation. Risk is permanent loss of capital. The S&P 500's volatility is the price of admission for real growth. How to use the S&P 500 in a balanced portfolio. In a diversified structure, the S&P 500 acts as the growth engine, complementing the defensive roles of cash and gold. Younger investors under 40 can allocate up to 70% here, accepting volatility for compounding potential. Mid-career investors 40 to 60 might hold 50 to 60%. Retirees often scale down to 40 to 50%, balancing stability with participation. Index funds or ETFs tracking the S&P 500 provide low cost, broad exposure without the selection risk of individual stocks. The strategy is mechanical but powerful. Contribute regularly, reinvest dividends, and let time, not timing, create wealth. Summary: the S&P 500 embodies the logic of capitalism itself. Systems fail, people rebuild, and productivity compounds. Across a century of turmoil, from the Depression to pandemics, the index has turned temporary chaos into long-term prosperity. Gold protects against monetary failure, and cash provides the flexibility to survive it. But equities represent the creative force that rebuilds value after every collapse. Together, these three positions form a closed loop of resilience. Cash buys time, gold buys stability, the S&P 500 buys the future. In the end, the equity market is not just a chart of prices, it's a chart of human progress. Owning it is owning the recovery itself. And that is why the S&P 500, despite every crash and every crisis, remains the third pillar of survival and growth in the century-tested investment pattern. Every market era tempts investors to believe the current environment is unique. Yet a century of data proves otherwise. Each cycle ends the same way: excess, correction, recovery.
Oh.
The difference between survival and ruin isn't prediction, it's balance. The three positions, cash and treasury bills, physical gold, and the S&P 500 index, are not independent bets. They are interlocking parts of one ecosystem, each thriving under different macro conditions and protecting the others when the environment shifts. Understanding how to balance them is the essence of strategic portfolio construction. 1. The principle of counterbalance. Every asset embodies a specific economic bias. Equities prosper when growth and productivity accelerate. Gold prospers when money loses credibility. Cash and T-bills prosper when deflation, panic, or liquidity shortages strike. In Ray Dalio's framework of the all-weather portfolio, these biases are balanced so that the portfolio can survive any of the four macro seasons: inflationary growth, deflationary contraction, rising inflation, and falling inflation. The objective is not to maximize short-term return, but to minimize long-term regret. When one position suffers, another compensates. When optimism drives equities higher, cash underperforms, but that cash is your buffer for the next downturn. When inflation erodes, cash gold captures the transfer of value. When panic forces liquidation, liquidity and optionality regain dominance. This tri-structure is elegant because it aligns with the fundamental drivers of the economic machine: growth, credit, and trust. 2. Allocating by life stage. A single portfolio cannot fit all investors. Risk tolerance and time horizon determine balance. Under 40 years old, time is your greatest asset. You can endure volatility and wait for compounding. A rational allocation might be 70% S&P 500, 20% cash, T-bills, 10% gold. The emphasis is on growth, using cash and gold purely as volatility shock absorbers. Ages 40 to 60. Capital preservation begins to matter as much as growth. Shift towards 60% S&P 500, 30% cash T-bills, 10% gold. This stage captures expansion but reduces exposure to prolonged drawdowns. Over 60, you no longer have decades to recover from a 50% decline. Balance tilts toward protection: 50% S&P 500, 40% cash T-bills, 10% gold. The goal is stability of lifestyle, not accumulation of wealth. The logic behind all three profiles is identical as just the mix, not the method. 3. Rebalancing discipline. Diversification works only if rebalancing enforces it. Without discipline, investors let winners dominate until the next crash reconcentrates risk. A professional framework is mechanical, annually or semi-annually. Compare actual weights to target allocations. When an asset drifts plus or minus 10% from its target, trim or add. During crisis, rebalance with conviction by what everyone else is selling. Rebalancing is the physical act of contrarian thinking. It monetizes volatility by converting emotion into arithmetic. In practice, this means selling a portion of equities after multi-year rallies and replenishing cash or gold reserves. Then, when panic sets in, reversing the trade. Over decades, this process converts randomness into consistency. 4. The psychological hedge of portfolio's greatest weakness is not its composition, it's the investor's behavior. The three-position model is as much a psychological hedge as a financial one. Cash tempers anxiety. Knowing you have liquidity reduces the urge to sell during a crash. Gold provides existential reassurance when policy credibility breaks down. Equities give optimism and participation in human progress. Together, they address fear of loss, fear of inflation, and fear of missing out, the three emotions that destroy performance. In crisis environments, most investors swing violently between greed and despair. Balanced investors remain centered because they already own something that benefits from every outcome. Its stability of mind compounds as surely as returns. 5. The mathematics of balance. Over the long run, balanced portfolios exhibit smoother compounding. A 100% equity portfolio might average 10% annually, but with 40% drawdowns. A balanced mix of 60/30ths, 10. S&P, cash/gold may average 8% with half the volatility. That lower volatility is not trivial. It reduces behavioral errors and increases geometric returns through the mathematics of compounding. Remember, the path of returns matters as much as the average return. Investors who avoid large losses end up wealthier than those who chase peak returns but suffer deep declines. 6. Current macro alignment 2025. Today's conditions mirror the prelude to previous corrections. Record global debt and fiscal deficits. Central banks oscillating between tightening and stimulus. Geopolitical fragmentation raising tail risks. Smart money has quietly positioned itself. Buffett hoards cash, central banks hoard gold, and institutions maintain equity exposure through low-cost index funds. Each piece of the triangle is already in motion. For individuals, replicating that pattern is not imitation, it's alignment with the same macro logic guiding the world's largest capital allocators. 7. The strategic mindset. Balancing these three positions is not about chasing performance. It's about engineering resilience. The goal is simple. Stay liquid enough to seize opportunity. Stay protected enough to survive monetary debasement. Stay invested enough to capture human progress. This triad converts uncertainty into inevitability. Markets will fluctuate, currencies will devalue, crises will continue, but a properly balanced portfolio absorbs those shocks rather than reacts to them. The result is not just financial survival, but emotional stability, the ability to think clearly when others cannot. That clarity is the rarest and most valuable asset of all. Summary: a century of evidence shows that no forecast consistently beats preparation. The balanced portfolio: cash for flexibility, gold for protection. Equities for growth is the structural antidote to uncertainty. It is not complex, but it is powerful because it aligns with the basic mechanics of the economy. As Dalio often notes, if you balance well, you don't need to predict. The next crash will test everyone's convictions. Those who built balance will watch it unfold as opportunity. Those who didn't will watch it as disaster. That difference, the discipline of balance, is what separates temporary wealth from generational wealth. Every century leaves clues. When you compress 100 years of financial history, 5 market crashes, 2 world wars, multiple monetary regimes, you begin to see that markets are not random. They oscillate around recurring forces: credit expansion, inflation, and human emotion. Recognizing these patterns is the bridge between surviving one cycle and thriving through many. Most investors operate reactively. Geopolitical fragmentation and de-dollarization. Smart money has already adjusted. Buffat's $325 billion cash hoard signals caution. Central banks are buying over 1,000 tons of gold per year, the fastest pace since 1950. Institutional portfolios remain anchored to diversified equity indices. The same configuration that protected capital in previous crises is quietly forming again.